Hello everyone, and welcome. Today, we are going to be decoding a really crucial part of the new Income Tax Act 2025. We're talking about Section 113. This is the section that deals with speculation losses, and trust me, getting this right is absolutely essential. So let's jump right in. So let's start with a situation many of us have probably thought about. You've had a tough run in the market, maybe with some intraday trading, and you've lost some money. The big question is, can you at least soften the blow by setting that loss off against your salary income? Well, the answer isn't quite that straightforward, and Section 113 is where we find it.
All right, so here's our roadmap. We'll start by understanding what a speculative transaction actually is. Then we'll get into the golden rule for setting off these losses and what to do when you need to carry them forward. We'll even walk through a practical case study to see it in action. And of course, we'll cover compliance and common pitfalls before we wrap up with the key takeaways.
Okay, first things first. Before we can talk about the rules, we have to understand the foundation. What exactly does the tax law mean when it says a speculative transaction?
Now, for all the tax professionals and CAs watching, this is pretty interesting. The key takeaway here is continuity. You'll be glad to know that the core principles haven't changed at all. Section 113 in the new 2025 Act is basically the new address for what used to be Section 73 of the 1961 Act. The 4-year carry-forward period? It's exactly the same. So no need to relearn the fundamentals here.
So here's the official definition, straight from the book. But let's break it down. Think about intraday trading. You're buying and selling shares on the very same day, right? You never actually take delivery of those shares. That's the key. The contract is settled without the actual asset ever changing hands. That's a classic speculative transaction.
But, and this is a big but, the law is smart about this. It knows that not all transactions without delivery are pure speculation. For instance, if you're a manufacturer using a contract to lock in the price of raw materials, that's hedging, not speculating. Same goes for an investor using derivatives to protect their portfolio. Those are treated as genuine business activities.
Okay, now that we know what is and what isn't a speculative transaction, let's get to the main event, the golden rule of how these losses are treated.
And here it is. This is the absolute heart of Section 113. It is incredibly strict. A speculation loss is basically ring-fenced. It can only, and I mean only, be used to offset a profit from another speculation activity. Period. It lives in its own little bubble, completely walled off from all your other income.
This slide just lays it out in black and white. So that loss from your intraday trading, no way can you set it off against your salary or your normal business profits, or even capital gains from your long-term investments. Its one and only purpose is to be set off against any speculation profits you might have. That's it.
So, the obvious next question is, what if you have a net speculation loss for the year? You have no speculation profits to set it against. Does that loss just disappear? Well, not right away. And that brings us to the rules for carrying losses forward.
And here's the magic number you need to remember: 4. You get 4 subsequent tax years to find speculation profits to set this loss against. But be warned, this is a hard limit. Once that 4th year is up, any loss that's left over just expires. It's gone for good. This timeline really helps visualize it. So you incur the loss in year 1. That starts the clock. You then have year 2, year 3, year 4, and your final shot in year 5 to use it against any speculation gains you make. If by the end of year 5 you still haven't used it all up, poof, it vanishes from your tax records.
Now, please pay very close attention here. This is probably the single most important compliance rule we'll talk about. If you want the right to carry forward that loss, you absolutely must file your income tax return for that year on or before the due date. If you file a late or belated return, you lose the right to carry forward the loss completely. And the new act has not changed this rule one bit. All right, enough theory. Let's see how all of this works in the real world with a practical case study. Let's meet a taxpayer named Mr. Akash.
So here are Mr. Akash's numbers for the year. He's got a good salary, profits from his textile business, a decent speculation profit from some share trades, but also a larger speculation loss from some other trades. Now the big question is, how does this all come together to figure out his taxable income?
On the left, we see the mistake that's so easy to make, just adding up all the income and subtracting the loss. That is not allowed. The correct way is on the right. You can only use the speculation loss against the speculation profit. So Mr. Akash's 1 lakh profit absorbs part of his loss. That leaves him with a net speculation loss of 50,000 rupees, which he can now carry forward. His taxable income for this year It remains at 17 lakh rupees from his salary and his textile business. The loss doesn't touch it. Okay, let's quickly shift gears and talk about some essential compliance tips and the common traps you really want to avoid. You know, good record keeping is really your best defense here. Always keep your speculative trades clearly separate from your long-term investments. Document any hedging contracts properly. Make sure you report the loss in the correct schedule of the ITR. And, I'm going to say it one more time, file on time. There are no exceptions to this rule.
So here are the top 3 mistakes we see all the time. Number 1, trying to mix apples and oranges by setting off this loss against salary or capital gains. Don't do it. Number 2, forgetting that the 4-year clock starts ticking in the year the loss happened, not the year after. And number 3, again, filing late. A late return means that right to carry forward is gone. Forever.
Okay, we've covered a lot of ground. Let's bring it all home and summarize the most critical points you absolutely need to remember about Section 113. So if you only remember 4 things, make it these. 1. Speculation loss is strictly ring-fenced. 2. It has a 4-year shelf life. 3. Timely filing isn't just a good idea, it's non-negotiable. And 4. For all you professionals, the substance of this law hasn't changed from the old act. It is clear, it is consistent, and now you know it inside and out.
And that's our deep dive into the rules of Section 113. I really hope this breakdown has made things crystal clear on how to handle speculation losses under the new act. Thanks so much for joining me. If you found this helpful, please do like, subscribe, and share with anyone else who might benefit.
Just a quick reminder, this presentation is for educational purposes only and is not professional advice. Tax laws are always subject to change, so please consult with your professional advisor before taking any action. This is an AI-generated educational presentation.